Hey ladies and gentlemen, welcome back to the channel. As always, it is Nick here, back with your daily crypto news and analysis. And today we're going to be talking about Ripple and XRP, as was the vast majority of crypto and finance. Let's just dive in and let's start off with the big events this week. So we do have quite a bit of economic reports coming out this week. I will say this: Wednesday, Thursday, and Friday are the big ones to actually look at. That's where we do get quite a bit of the actual economic outlooks and reports. Now remember, this is the March reports for the most part on Wednesday. On Thursday, we also do get some reports from April. Same with even on Friday, but we also do get a report from February. But for the most part, we want to look at the March ones. I will say this: there could be a few events that do lead to like the US dollar, if you will, having a little bit of a pullback, which is bullish for the market. But we have been watching the US dollar for a while, and it's going to be on a slow period, which I'll talk about here in a second. But for the most part, yes, there was quite a bit of economic reports coming out this week, which is going to be pretty big. Next week, we do have a few, but they're not as significant as the ones that are happening on Wednesday, Thursday, and even on Friday. So definitely stay tuned to see that. I think that that's mainly what the market is waiting for, at least, because we've just been trailing sideways, which I'll also mention. But with the US dollar, this has been a big moment of truth that we've been waiting for. And we finally got what we were waiting for. We got a little bit of some price action. For an example, here is the daily. We've kind of been trailing around this level for a while. We are still testing EMAs on the daily chart. On a 3-day chart, we're kind of getting to that point as well. I'm just looking at this thing on the weekly, and again, going off of Fibonacci levels, you don't really need to look at them too much. All you really need to look at is that March of 2020 candle body. So again, what I've been looking at around the US dollar is this range that we've been between, and it's essentially us testing local resistance and also us testing us testing local resistance, and also us testing resistance from March of 2020 that we flipped into support and we've been kind of just holding on to. Now we could probably test in between this level for a while, kind of just trail sideways, waiting for the big break to the bottom or to the upside. Now yes, what will be bullish for crypto is us breaking down. I still have been looking at this, and I've been watching this for a while, and we have been waiting for either possibly a rejection off of support, aka the March of 2020 resistance area, or us coming back up, having this major push back to local resistance, and then getting that strong rejection, which would be the most logical thing to happen on the US dollar. But I've also been looking at the EMA, the weekly 200 EMA, this blue line down here. And the reason why is because this is going to be the moment of truth for crypto. Everyone has been waiting for a big blow off top, a wave 5, this, that, whatever. But until we get that breakdown on the US dollar to this level down here, we're not going to see anything significant. Why? Well, going all the way back to the level of March of 2020, during this time here, yes, the market did do very well in terms of crypto. We started to see DeFi tokens running and all that. Very similar to what we are seeing here, where we started to reject back in the end of February. Now, yes, it didn't really start until we lost the 50 weekly EMA, which was this level here, back here. Now, yes, during this time as well, we started to see the market do very well. It's still doing pretty good right now because of the weakness on the US dollar. But what I would love to see is us reject off of the 200 weekly EMA, because guess what? That's when the real fun started, during the summer of 2020, all the way until we broke out of this in November of 2021, aka the signal that the bull run was finished. So what I'm looking at is us to break down below this 200 weekly EMA. And once we do lose this level, that's when the real fun begins. Now, do I think that the fun will start beforehand? Yes, 100%. I think that it has already started. When we look at the total, we started to break out really back in the end of December, as you guys do see here. This was because of the US dollar. This is the total market cap of crypto. Now, as we look over here, so this is the total too. We have been ranging around the 236. We have regained this, which is good because, again, this is the summer of 2021 low. I love to see this actually flipped into support. I hope that this can continue higher. What I'm mainly looking at is the 618, all the way up to about like the 786, which is between 1 to 1.26 trillion dollars. So anywhere up here as a retest in the short term would be huge for the altcoin market. But what I'm looking at right now around the total is, one, we have just been kind of trailing here, waiting for a big break. The same goes for Bitcoin. We've been waiting for a big breakout. And the more and more that we test between this level, like, yeah, this is technically squeezing. Everyone thinks that we are about to just blow to the top. I will say this. If we were going to blow to like 40K or 30K plus already, we would have seen that. I expect us to retest anywhere between 25.3 to about roughly 23.5K and then have that continuation higher. So something like this would be welcomed in. I think that this will be welcomed in for anyone out there, as everyone is extremely bullish right now. I'm just trying to look at this and say, well, what if we do the opposite? What if we see the dollar kind of regain a lot of strength here and a lot of momentum and get that impulsive move back to like 104, and then we get that rejection? That will be the move to, one, retest anywhere between this level. It doesn't have to come back down to like 23.5K. I will welcome 25.3K and actually flip this into support and then have that higher continuation. That will be welcomed in. But this will also lead for most of the market to have that rejection down. What I'm mainly looking at on the total is probably around like $981 billion. So that's what we are looking at. In the short term, at least. In the long term, yes, I do think that crypto is going to be doing very well this year because, one, I believe that the market is going to rely on what happens around the banking system. With banks right now, I will say there's a lot of warning signs around the banking sector, which I've been mentioning quite a bit. But also, as we look at the US specifically, the White House and even the Federal Reserve have made it a mission to make sure that we are all cradled for. What do I mean by that? Well, basically what they are saying right now is everything's safe, everything's secure. You don't have anything to worry about. As they are telling us this, one thing continues to click in my mind. They are trying to fool you. They are trying to get the sheep to follow along. Nothing is safe right now around the US banking system. I don't believe that the US economy itself is even safe. I've mentioned this many times on this channel as well. As everyone thinks that we have beaten the recession, the depression, whatever, we're in this transition period. What do I mean by that? Well, basically, I believe that we are transitioning from the traditional world of finance to the digital world of finance. There's a big plan behind all of this. One of the biggest things that I've seen get posted over on Twitter was from digital asset investor himself. And it's this video. It goes all the way back to 3 years ago. And we do see Digital Currency Wars, a national security crisis simulation streamed at Harvard 3 years ago. We're supposed to believe the US is just helplessly watching the BRICS destroy the dollar. If they were wargaming this publicly 3 years ago, what were they planning for decades before in secret? Digital currencies didn't just happen, folks. Listen closely to this video.
As we heard from the Secretary of the Treasury and our very effective new cyber currencies are, we need a strategy to, one, modernize our SWIFT system. I think the word was harden from cyber attack, from the North Koreans in particular. But we need to develop and present options to the president for a US equivalent of a digital currency, either a private-public partnership, or if the Treasury is able to do it with the Fed, something that would be a public-only option. And we'll have both the Secretary of the Treasury and the crypto czar follow up on that. And as we mentioned from the Vice President and the Secretary of State, we need a strategy to resuscitate U.S. financial prowess, I think is the way you put it, Madam Vice President.
So yeah, I mean, I do believe that there is a lot of things behind the scenes that have been planned. First off, the FedNow system, right? We've talked about the FedNow system. When that rolls out in July, it has systemic risk tied to it. There's not enough liquidity in the system for 24/7, 365 payments. There's just not. Liquidity right now is probably at the tightest that it's been in a very long time. And as we look at the credit crunch as well, Caitlin Long posted this yesterday on Twitter, and we do see credit crunch. U.S. bank lending contracted by the most on record in the last 2 weeks of March. The most in Federal Reserve data back to 1973, primarily due to the drop in loans by small banks. We do see U.S. bank lending decline sharply for a second straight week. Also, as we look at the Fed, the pullback in Fed liquidity remains the key feature working beneath the surface. Pre-bank failures, it resulted in 2019 like reserve scarcity, particularly at small banks. Fed emergency injections have bought time to figure out, but QT days are numbered. And yeah, like as we look at what's happening right now, there's not enough liquidity in the system. Banks are basically, at this point in time, not lending because, one, they don't have enough there's not enough liquidity in the system. There's just not. That's why we started to see banking collapses going all the way back, I guess, what now, a month ago now? But we've seen from that time a lot of systemic risk still flash in red. We still had a lot of issues within the system. Now, Peter posted this video over on Twitter, which I've had his videos in some previous ones. And we do see Fed warns of silent bank run. This video is about 3 minutes and 35 seconds long. I want everyone to listen closely to this because I think that this is something significant that everyone needs to listen to. And also why I have been adamant about, one, the banks. Banks are just not safe right now. They are not your friends. A lot of people think that this is just me being fearful. No, this is me being realistic. The banks, they do not have liquidity. We have started to see major, and I mean major withdrawals from banks, over $300 billion worth. And this is like some of the largest withdrawals that we've seen in well over a decade. And do you think that it is a coincidence that at the same time, we started to see banks start to collapse? We start to see the FDIC come out and tell everyone that their deposits are covered, that everyone's safe, and also even the White House reporting on this. No, it is not. We are seeing the warning signs flash again. Listen closely to this video.
Hey guys, on Tuesday, the Fed took a break from playing arsonist and played fireman, sounding the alarm that trillions could start draining out of banks in a silent bank run, implying yet greater several trillions could soon drain out of the U.S. economy. This could endanger the banks yet again, driving them yet again to the comforting embrace of taxpayers eager to sacrifice our life savings to cover their gambling debts. More important, and as a creative thank you for our generosity, this could crush the economy. In the Fed's paper, they looked at the past two rate hike cycles starting in 2004 and 2016. In each, they found a big jump, trillions, going from banks into money market funds. Now, money markets are like a bank account, a nice place to park your dollars, but this is key, money market funds cannot be fractionally reserved. That means that while a dollar in the bank system is spawning roughly $3 more via fractional reserve, like hamsters, they multiply, a dollar in a money market fund is just a dollar. It's not quite as good as a full reserve bank. After all, money market funds still put your dollars in risky government bonds instead of cash, which is king, but they're close. In gory detail, in the 2004 cycle, money market funds doubled from about $1.5 trillion to $3 trillion. And in 2016, they rose 40%, from $2.5 trillion to $3.5 trillion. Why did this happen? For two reasons. First, because high rates mean the gap between what you make in the bank and what you make in a money market fund is bigger. You're losing more sticking with the bank. For example, in 2020, interest rates were about zero, and both money markets and banks also paid about zero. But with rates almost 5% now, money markets also pay about 5%, but banks still pay about zero. Second is fear. In the 2008 crash, and again during COVID, money market deposits rose because of fear the banks would collapse. After all, the kind of people who move billions in and out know it's a Ponzi. They know that banks are permanently bankrupt, living handout to handout. Note, both hike cycles were smaller than today. The 2004 cycle was about 4 points in 2 years. The 2016 cycle was about 2 points in about 3.5 years. Today's is already bigger than both, and that's in a single year with more to go. So now we have a perfect storm. COVID fear, epic rate hikes, and a 2008 all rolled into one. All right, what does this mean for the rest of us? More pain. The reason is that thanks to Wall Street's fractional Ponzi, every trillion going out of banks into safer assets like money markets perversely shrinks the economy by several trillion. The fractional reserve pretend money vanishes. So yes, the economy is living on risk. This shrinkage hits hardest in loans. With trillions less to lend, banks will stop making loans. They'll stop renewing loans. They could even call in existing loans. So businesses are strangled. Essentially, the economy shrinks from its current counterfeit fortified size down to its true size. The artificial boom, based on artificial money, deflates. Unfortunately, right-sizing the artificial boom means a lot of bankruptcies. It means a lot of layoffs, a lot of jobless. If you like your job, you cannot keep your job. Of course, the economy is already shrinking, even today, without the extra help. In Wednesday's video, I talked about job openings crashing. They're down 1.2 million in about the past 2 months, and fresh jobs numbers this morning are already looking grim. Toss in another couple of trillion, draining out in a flight to safety, and it could get bumpy. All right, we'll be watching.
And again, this is why we are watching these significant reports coming out, because all of this leads to what is actually happening behind closed doors. Because we have this blanketed report from the White House telling us everything is safe, that you should keep your money in the US banking system. Listen, they want you to hoard your money in these banks, because when things really start to go bust, guess what ends up happening? They utilize your funds, your savings accounts. A lot of people don't know the warning signs behind the FDIC and what they have done. They have created a bail-in report around these banks, which means they could utilize the funds that you have deposited into your account, because technically speaking, the money in a bank is like crypto on an exchange. It really is not your money. That's what the falsified idea around banks has always been, is this narrative that, hey, because your money is in a bank, it is covered. It's your money. It's not the bank's. That's a false narrative. And the FDIC has debunked this idea many, many times in the past, saying, hey, we can do bail-ins. If a bank needs to, they could bail in your money and utilize it to cover a crash. This is the biggest problem that we do see around our current economy. This is also why I have been saying that we need to stockpile physical gold and silver. We need to make sure our money is not in bank accounts. And yeah, technically speaking, we have been looking into crypto. We have been buying crypto, because right now, I believe that crypto could very well be a hedge against what comes next, which I do believe that banks are going to start to collapse. We start to see a major amount of liquidity coming over to crypto when those banks start to collapse back in the end of March. We start to see the market really go parabolic during that time as well. This is basically the idea of the banks collapsing here back in the beginning of March, middle of March, and the market had rebound quite a bit and actually did a very nice run up. And I think that that's what we are going to most likely see. I think that this is one of the bullish narratives around crypto right now, is the fact that, one, although they want you to believe that the banking system is safe, realistically speaking, it is not. So with that being said, I hope that you guys enjoyed this video. If you guys did, definitely leave a like, subscribe, turn notifications on if you guys have more free content. You guys are more than welcome to follow me on Twitter and join the free Discord down in the description below. So it's up to you all. Have a beautiful day or a beautiful night wherever you guys are in this. Before this, been Nick. Peace out, guys.